Hey traders, welcome to Charts and Coffee. Great to see everyone. I'm on my second vat of coffee today. We've got, for those of you that'll be joining me in the Sector Secrets Mastery, we'll be starting up right after the show. And then for those of you in the options room, I will see you all there from 11:30 to 12:30 today. So I have we'll be together in one way or another between now and 12:30. So we got a lot of time to take a look at the morning, both short term and longer term together. I'll be keeping a really close eye on Crude. If you already didn't check it out, I did a video on Crude as far as how today's candle is the kind of candle I'm looking at to look for a bounce, not an uptrend, just a bounce, potentially to the upside. So we got into the details of a specific setup after a fairly dramatic sell-off yesterday. That why timing matters, why just because a market is down doesn't mean it's going to bounce, why the zone and the behavior of the candle after a sell-off matters. Lots of great information in that video if you have not already checked it out. What else do we have coming up? Well, gang, we are now kicking into the really from a hot zone perspective. What's a hot zone? It's just a phrase that I use to describe a scheduled, that's the most important part, scheduled, high impact, high volatility event. And the phrase came from my use of Forex Factory back in my early Forex trading days, early 2000s. The little red icon, how do I explain to a new trader how to understand what's high impact versus what's not? Every one of these events is not high impact, but the little red ones are. So we call those hot zones, right? Red hot. CPI came out this morning, and that's a pre-market hot zone opportunity for traders who are looking at a morning day trade. Expectations, there were some pretty big time whisper number conversations happening into the close yesterday where there was a leaked, some folks said it was leaked, I don't know, but all of a sudden we saw a pretty dramatic sell-off in the equity markets because CPI was expected to be running higher than expected. Gang, higher CPI is going to force the Federal Reserve to have to focus on the continuation of the rate hikes, not necessarily past the probability on the upper end of 3.75% to 4%, but it's not going to be favoring the 3.25% to 3.5%. And that zone, somewhere in the low end of 3.25% to the upper end of 4%, that's where the market has sort of found a sweet spot. Now, when we vacillate between the lower end of that range and the upper end of that range, equities are going to respond. If you've ever caught any of my macroeconomic videos that I cut at least a couple times per month, you can, of course, catch that as a member of the Futures Room or the Sector Secrets Mastery. But by the way, you can also see glimpses. I'll share some broader strokes for that in the free videos that I do at the Simple Trading YouTube channel on Tuesdays and Thursdays. And heck, we even touch on that on our Sunday weekly show. So we'll keep that conversation going. There is not a reality right now that would look at a CPI at 1.3 and generally it not favor lower prices in equities, right? Not that we have to sell off dramatically, but stonks ain't gonna like it. Now, my mastery folks, this movement lower and this CPI bodes really well for our open shorts. We grab some sectors. Why wouldn't we do that in the Sector Secrets room? So that's kind of my gig, looking at sectors, looking at ETFs. Love them. It's been a very active part of my approach since around 08. And that's, by the way, why? Because that's when ETFs started moving higher and mutual funds started losing their traction in terms of market share in many ways. So XLF and XLC are going to be absolutely looking very good for us. Nice gaps down, wonderful in favor of our first targets, which it looks like we're going to hit. So if you're in the mastery room, that might be the first thing we're doing. Nothing like rigging the cash register on the bell. All right. After all, I would love for you all to, after all, the whole idea of the kind of trading that we do, whether we're day traders whether we're swing traders, whether we're looking at weekly timeframes, is to find those opportunities and be process driven about them, right? So that's going to be the process this morning. Of course, our show is about your questions, and I'm taking a look at them right now. First one up. Hey there, Kelvin. What is the stock equivalent for trading the euro versus US dollar? That would be an ETF called the FXE, which is actually kind of disappointingly illiquid when you look at the option chain. But in terms of buying the underlying ETF, this is known as a currency share. The currency share ETFs, and we have them for euro and pound and Canadian dollar, Australian dollar, yen. The liquidity of the ETF is okay. The liquidity of the option chain level can be a little thin, and that is it. Now, you can also look at, and it's not 6 of one, half dozen the other, but Douglas, thank you for bringing up UUP. So Euro US is FXE. The US dollar is the dollar basket. It's 50, almost 58% euro, and then some fairy dusting, and well, it's 58% euro, distant second Japanese yen, and distant third pound sterling. And then after that, we have 3 other currencies that are sort of fairy dusted within this basket. So it is a high concentration weighted basket of currencies, mostly euro. If you want to have the best look at the euro, looking at FXE, the second best, to Douglas's point, would be the UUP or the US dollar index, okay, or that US dollar index futures contract. So thank you, Kelvin. Thank you, Douglas. Awesome. I love starting the day with some currencies. So fantastic. And by the way, those are the biggest markets on the planet, no doubt. Mike asked, does the new daily low in crude oil eliminate a long entry today? No, Mike, I'm looking for a potential minor low, and that is exactly what we're getting. Buoying back above the 200 propulsion and that Darvis level that I outlined in the video. Now, that's exactly what a minor low should look like. Ideally, a minor low entry would be tomorrow's session, but we can be a little aggressive today with an aggro budgeted entry. So no, it absolutely does not. The only thing that would undo this is if that trend reading, take a look at that label right there. Gang, that label is the easiest and for me, the most accurate way to understand market structure. No secret squiggles needed. Right there. What is the color? Traffic light symbol. Or if you're on the multi-trend, look at the lower row of that indicator that you'll see at the bottom of my charts, the bottom of my screen there. As long as that remains neutral, we can continue with an expectation for maybe that level being oversold. And if it's oversold, we've got a price level. Yeah, that's still a valid trade for me. Great question. All right, next up is, was it the CPI that made everything collapse at 7:30? Well, we can go take a look at the intraday time frame. So when we say everything, remember, let's be very symbol by symbol specific. Look at, so this is yesterday after the clearing range to where we are right now. So this is yesterday's action to that CPI candle. This is a little thing, something I call guillotine syndrome. What is this? First of all, we sold off into the close. Maybe there was a whisper number. Maybe there were expectations that CPI would be hotter, higher than expected. Remember, the CPI is right now the arch nemesis of the Federal Reserve, right? If we're thinking about the octagon in MMA and it's a UFC fight, we've got Kapow in one corner and we've got inflation in the other, and that's where the battle is happening. Hotter than expected inflation is negative to equities because it allows the Federal Reserve to keep on with a fairly hawkish trajectory in their current monetary policy. Hawkish meaning they favor rate hikes, right? Okay. Now we get this data, this hot zone that is one of the 3 macroeconomic pillars: growth, jobs, inflation. This is probably the most important of the macroeconomic pillars. This is wait and see. This is guillotine, right? What do I mean by that? That means that the markets will not want to stick their necks out in front of this event. They just kind of hold steady. They hold steady and they wait to see. And there was a little bit of an initial reaction to the upside and then bam, right? Maybe those were traders who were long covering, as well as traders who wanted to build short positions into that brief moment. Who knows? And frankly, in many ways, who cares? We know a couple things. As we take a look at this market moving sideways, I don't want to front run the data. I don't want to guess at which way the CPI is going to move the market. We wait for the market to initially move to the upper or lower end of a volatility range, and then that's what we look to take advantage of. I did not trade CPI this morning, mainly because this is going to be a massively high volatility event, more so than non-farm payroll in many ways, more so than GDP in many ways. This is a massively volatile potential hot zone because, well, yesterday we were already starting to see the shenanigans into the close. So I decided, you know what? This is a risk management decision. Let's forego this one because there's a lot of emotion and psychology wrapped around it. I'll be trading retail sales on Friday as an 8:30 hot zone, but CPI, I said thanks but no thanks. Way too much, and you can see how volatile this was. So there you go, Mike. There is the right there. There's the move. Okay. All right. Next up. Yeah, I agree. No, we say worse, right? Let's be really specific. Corey, you're absolutely right. The number was expected to be 1.0. It came in at what, 1.3? Higher than expected is worse for stocks, but it may be good for other corners of the market. Remember that. It may be good for other corners of the market. Crude oil didn't mind it so much, did it? But stonks will not be happy. Absolutely. All right. Next up is the multi-trend. Hey there, Elvis. Is the multi-trend a free tool or premium? Well, depends on where you are. If you're in any of my classes, that's included with the classes. It's free with the classes. If you're in my Sector Secrets Mastery, it's included with the Mastery. It's free with the Mastery. If you're not in any of those scenarios, it is a premium tool. Yes. But the places where traders follow me, whether it be class or my Mastery, I make things like that available to them. So thanks for the question. All right. So has inflation peaked? So Jess, look, there's been a lot of traders. There's been a lot of conversation amongst traders and investors about inflation peaking. There's two measuring sticks. One is PCE, which actually has flattened out, and there's CPI, which has not. CPI is the world we live in. PCE is the world that the Federal Reserve likes to think we live in. I think the PCE is really a bunk, just garbage number, but that's their favorite. So guess what? It becomes the most important. The world we live in, the world that affects our purses and wallets and bank accounts, and that's CPI. And that has not peaked. So when we talk about inflation peaking, we have to ask ourselves, what are we measuring on a rate of change basis? Here's the funny part. Most traders don't even look at this data, right? Anyone talking about a peak in inflation, unless they're citing the PCE specifically, they're just throwing that out there. It's clickbait conversation. And the amount of clickbait conversation that's out there, whether traders putting out some S&P target to the up or down side, whether traders talking about whether certain inflation levels have peaked, whatever, that's clickbait stuff. We don't do that here, right? We know better. We know better. So the idea is always rate of change. And CPI has not cooled off in any way, and it showed it again today, still moving higher. And the Federal Reserve may not take that as seriously because, like I said, their favorite, their measurement for inflation is the PCE, which is up but slowly leveling out. And that is where, that whole inflation peak. And I look at not inflation. Look, I put a setup out there last Thursday. If you haven't checked it out, the light at the end of the bottom, that's not picking a bottom. That is saying the process for bottoming has begun, because as long as, let me show you here, we always measure this. Gang, if anybody puts an idea out there, hold yourself to the standard, hold me to the standard, hold anybody who's going to throw analysis at you to the standard. Why is the Federal Reserve potentially, well, in terms of the messaging that we need to glean from it, why are they pretty much done? And why is the market down? Well, I'm going to show you right now. This is really easy to understand. This column, and this column. These are the ones in play. Drama will occur to the downside if we exceed this third column to the right, and a rally and lots of jubilation will occur if we exceed and go lower than the column to the left. All right. As long as we're here, there's nothing really new, and there's no reason for the market to rally, really, but there's no more reason for the market to really sell off either. This is the measurement. This is where all the inflation and all the GDP and all the jobs growth and all the blah, blah, blah from all those FOMC chuckleheads, this is where it's best measured. Okay, which is why I show you all this so much. So shout out to the CME for making Fed Fund futures and this graph available and so easy to read. The inflation number, the jobs number, the GDPs really are all going to get baked into this. Our equity is going to be upset. Yes, because what's happened is there was a probability that we might stay at this 325 to 3.5 basis points or 3.25 to 3.5 point column. And that now has gone away. We're right back to where we have been. This is the sweet spot, gang. This is where we have been, right? And what's also then now come into play? The 3.75 to 4% column. So basically the two extremes around the center have swapped. Rather than favoring a little less hikes, we're now looking at a little bit more. Equities won't have to make brand new lows in terms of the range because of that, but it's going to favor more weakness and more bearish momentum because of that. And that's how we measure it, gang. It's really not that difficult. You don't need to be an economist to do this. You just need to do what you already do as a trader, which is you look at the rate of change, whether it's the rate of change of price, whether it's the rate of change of your secret squiggle, right, your favorite indicator, or it's the rate of change of macroeconomic data. That is the only way to have a process in the market. And again, inflation peaking maybe on PCE, but it has not on CPI. And again, you can draw charts of that stuff too. All right, maybe we'll do that another time. And by the way, if this kind of analysis appeals to you, we talk about this stuff 5 days a week, nearly in my Sector Secrets Mastery. You can join us. We're going to be expanding the schedule, not changing it, expanding it. Heads up for that probably later on this week, adding more day trading to the schedule. We have a portfolio macroeconomic, longer term time horizon session. And then we have the heart of the service, which are daily swing trades like the XLF and XLC long put, taking advantage of weakness position. So if you're looking for a well-rounded approach where you're tackling all those major time horizons and time frames, I think you'll love what we're doing over there. All right, next up, do I ever trade right off the zone news, like when CPI dropped immediately this morning, or do I wait for it to settle down? So I wait. So I don't want to be pre-positioned. I like to be post. But in the Simpler Trading YouTube channel, you have to go back a little bit, but I live streamed my trading, the last CPI, non-farm payroll. You'll have to scroll back a bit, but you'll see the hot zone session. This is the PCE hot zone session. So just scroll the videos and find those hot zone sessions. I believe there's 2 or 3 of them that I've done. And I'll probably try to do 1 or 2 a month live streams so everyone can see my day trading and HPMRs at work. You know, I really want y'all to see how they work. So I did a PCE, there's a CPI, and then I did do non-farm payroll from June. So you can watch me trade these live streamed. Just look for those hot zone sessions under the videos over at the Simpler Trading YouTube channel. And like I said, I'll probably do 1 to maybe 2 of those a month for everyone, whether you're a member or not. You can catch it on YouTube. So just sorting that out right now, what that schedule is going to look like. So stay tuned. I'll let y'all know. All right, next up is the weekly. The weekly. Okay, let's take a look at a weekly. I love it. All right, Avi asked, the weekly JT multi on QQQ is double red, which I didn't see that at the last 10 years. What do I think? So first of all, if I'm going to look at QQQ, it's going to be the NQ. Because remember, QQQ is the sort of truncated 9:30 to 4 window of price action, while NASDAQ futures, the NQ, is that nearly 24-hour view of what the NASDAQ is doing. So first of all, I'll go there. And then second, yes, it is double red. It's been a minute, right? It has been a minute. We've had well over a decade of very accommodative action. And so what do I think of the double red downtrend? I really don't think the bears are in full control yet, because we're still clinging to, on the weekly, the bullish hemisphere by remaining above the 200 EMA propulsion. Yes, they're in control of the near-term trend, but getting below the 200 or staying above the 200, especially on the weekly or daily, that's where the battle is going to occur. And right now, the bulls are hanging on. The bulls are hanging on. All right. So I would view that as, yes, there's bearishness, but if we're going to see a level actually turn into support, this could be where it starts. And then I could start looking at the XLK, which is neutral, the XLY, that's red. So we're going to start then looking at what sectors and stocks, this is what we do in the mastery, what sectors and stocks are clinging to more of a neutral weekly. And that would ideally be where we start to slowly build longer term time horizon positions, position trading, right? Which is really, to me, almost synonymous with the way that I invest, built on the clarity of those weekly timeframes. And if you're interested in that, every Tuesday, 3 to 4 p.m., we touch on that very topic, the portfolio and macro view, longer term view of these markets. All right, gang, as always, thanks so much for being a part of Charts and Coffee. Time to go caffeinate and dominate over in the Sector Secrets room. We've got the Q&A live trading session happening now. All right, gang, be good to each other. I'll see you tomorrow.